Hello, my name is Edmond Jamna, and on behalf of DW Consult, I want to welcome you to Tutorials on the Go. Our zeal here is to help transition people with zero, struggling, or shaky base in accounting to an expert position and to a place of confidence. It is also a platform to assist in the smooth studying of the ACCA and ICA professional qualifications, as well as for any tertiary accounting discipline. All that is required of you is to subscribe to our channel and click on the notification bell as well to be part of the program. Tutorials on the Go, bringing accounting to heart. Now, to this episode's lecture. Income tax, IAS 12. The objective of IAS 12 is to prescribe the accounting treatment for income taxes. It recognizes both the current tax consequences of transactions and events and the future tax consequences of the future recovery or settlement of the carrying amount of an entity's assets and liabilities. Now, it is inherent in the recognition of an asset or liability that asset or liability will be recovered or settled, and this recovery or settlement may give rise to future tax consequences, which should be recognized at the same time as the asset or liability. Now, an entity should account for the tax consequences of transactions and other events in the same way it accounts for the transactions or other events themselves. Let's start with what a current tax is. Now, this is an amount of income taxes payable or recoverable in respect of the taxable profit or loss for a period. So the current tax should be recognized based on the year-end estimate of tax payable. So the income tax expense through profit or loss is adjusted for any under or over provisions from the prior year. So the current tax for the current and prior period is recognized as a liability to the extent that it has not yet been settled. So current tax assets and liabilities are measured at the amount expected to be paid or recovered to or from the tax authorities using the rates or laws that have been enacted or substantively enacted by the balance sheet. The following trial balance, which is an extract, relates to Charles as at 31st March 2015. Current assets, $400,000 to the credit. Now the following notes are also relevant. A provision for current tax for the year ended 31st March 2015 of $3.5 million is also required. The balance on current tax in the trial balance represents the under or over provision of the tax liability for the year ended 31st December 2014. So we have to prepare extract from the statement of profit or loss for Charles for the year ended 31st March 2015 and from the statement of financial position as at the same date with regards to tax. Let's look at the solution. The profit before tax was not given in this question, so we itemize it as an asterisk. Now the income tax for the year, ideally it would have been what has been estimated for the current year, which will be the current tax. It will be adjusted for by whatever happenings that transpired in the previous year. So for 31st March 2014, there was a $400,000 overpayment. So we will now less it from our current tax for 2015. So the income tax expense will be $3,100,000, which is the 3.5 current tax estimate, less the overpayment from the previous year. If the $400,000 were to be on a debit, it would have been an underpayment. We would have added it up to the 3.5, making 3.9. Okay, so the profit for the year will be, if you had any profits, less the income tax expense. When we come to the statement of financial position, it will always feature the current tax estimate for the year. It will not be adjusted for, as done in the profit or loss. Now, IAS 12 requires an entity to recognize a deferred tax liability or deferred tax asset for all temporary differences. Let's move on to discuss the various items in the note above. We'll first look at what a deferred tax is. Deferred tax arises when the accounting profit differs from the tax profit. We can have permanent differences. These are items that will be used in calculating accounting profits, but not tax profits. Example, entertaining expenses. So you can less entertaining expenses from your revenue to arrive at an accounting profit. But when you're calculating the profits for tax purposes, it will not be allowed. This will lead to a higher profit being paid. Let's look at the temporary differences. Now, these are items that are allowed in both the calculation of accounting and tax profits, but the value used will differ in both areas. Example will be depreciation for accounting profit and tax depreciation or tax allowance or capital allowance for taxation purposes. So depreciation might give you a figure that will be recognized in one period, but the tax will also give you another figure. So that difference that will exist, it is temporary because it will phase out in the subsequent period, meaning that difference has been deferred to subsequent period. So when you have one asset, at particular periods, you'll be having different values for depreciation and tax, but at the end of the useful life of the asset, it will be the same. So let's test our understanding. Tracy purchased an item of property, plant and equipment on 1st January 2015 for $5 million. It was estimated that it had a useful economic life of 5 years, but according to the tax authority, had a 50% tax allowance in its first year and 20% reducing balance thereafter. Tracy made an accounting profit of $2 million for the year, which is expected to continue unchanged for the next 2 years. Income tax rates is 20%. We are to calculate the profit after tax for Tracy for each of the 3 years ending 31st December 2015, 16, and 17. So the profits before tax was $2 million, meaning every expenditure has been taken away from every revenue and every income, giving us this profit before tax. So what is left in the accounting profits would have been to just apply the 20% on the 2 million to get the tax for each year, less it, and get the profit for the year. So, but when we come to the estimation for the actual tax to be paid, we would have to add the accounting depreciation back. Now, the depreciation was already worked out to arrive at the profit before tax, so we have to add it back for us to arrive at a different profit before tax before we apply the tax rate to get the actual tax. So the asset had a useful life of 5 years. So for 2015, it's going to be 1 over 5 times the 5 million, giving us 1 million. And because it's a straight line method, the 1 million will apply for all the years. So that will give us an operation profit for 2015 of 3 million, the same for 2016 and the same for 2017, because the profits were the same and the depreciation figures are also the same. Right. Now, when we come to the tax allowance, now watch the calculation down here. The asset is worth 5 million and the tax said they will allow 50% in the first year. So the tax allowance for 2015 is going to be 2.5. So we less it from the 3 million in 2015. When we come to 2016, they said 20% reducing balance. So the figure at 2016 is going to be 2.5. That is the 5 million original cost of the asset less the 2.5 already allowed times the 20%, giving us 500,000. So we less the 500,000 from 2016. We come to 2017, the balancing figure, what they normally call the tax written down value, will be the original price less the figures allowed so far, which is the 2.5 and the 500,000, times the 20%, giving 400,000. So we also less it from the operation profit of 2017. So the profit before tax for 2015 will be 500,000, 2016 will be 2.5, 2017 will be 2.6 million. So now watch the profit before tax for taxation and the one we had using the accounting policies. We realize that for 2015, accounting gave us 2 million, tax is giving us 500,000. 2016, accounting gave us 2 million, tax is giving us 2.5. 2017, accounting gave us 2 million, tax is giving us 2.6. These are the differences that exist purposely because of the depreciation of the asset that was bought in. Okay, so when we apply the 20% on the profit before tax, the tax element will be 100,000 for 2015, 500,000 for 2016, and 520,000 for 2017. So when we come to the statement of profit or loss, we will bring the actual profit because the profit or loss is worked under accounting policies. So we'll bring the 2 million here. Then we will now bring the tax that has been calculated using the taxation estimate. So for 2015, the tax was 100,000, 2016 was 500,000, and 2017 was 520. So giving us a profit after tax of $1.9 million for 2015, 1.5 for 2016, and 1,480,000 for 2017. Now let's look at some definitions related to the deferred tax concept. The first we'll look at is the carrying amount, which we already know is the original cost of an asset or a liability, less accumulated depreciation and or impairment losses. It is also known as the accounting base for an asset or a liability. The tax base, on the other hand, is the amount attributed to the asset or liability for taxation purposes. In other words, we can say it is the carrying amount under tax. Temporary difference. This occurs when the carrying amount of an asset or a liability differs from that of its tax base. Deferred tax liability arises when the entity would have to pay taxes in the future when the temporary difference is played out. Deferred tax asset also is when the temporary difference will cause the entity to pay less taxes when it is recovering the carrying amount of the asset or liability. Deferred tax also arises when the entity has unused tax losses or unused tax credits. Now let's look at the calculation of deferred tax. We'll start with the temporary difference. So as we have explained earlier, when the carrying amount is different from the tax base. So carrying amount less the tax base of an asset or a liability. Now let's look at the taxable temporary difference. So this is the difference that occurs when the carrying amount is more than the tax base of an asset or a liability. So the deductible temporary difference, on the other hand, is when the tax base is more than the carrying amount of an asset or a liability. Okay, so deferred tax liability will be the tax rate multiplied on the taxable temporary difference. So when you have your carrying amount of an asset or a liability being more than the tax base, and you multiply it by the tax rate, it will give you a deferred tax liability. It means that you are going to pay more taxes in the future as the carrying amount of the asset is being recovered, either by the sale or the usage of the asset or liability. Deferred tax asset, on the other hand, is when the deductible temporary difference is being multiplied by the tax rate. Here, the tax base of the asset is more than the carrying value at a particular period. So you'll be enjoying tax relief or tax credit or lesser tax payment when you are recovering the carrying amount of the asset or the liability. Let's look at the recognition of a deferred tax. The movement of the deferred tax for a particular year is recognized in the statement of profit or loss. How do we calculate the movement? You pick the closing deferred tax position, you less it by the opening value. Then the movement can be an increase or a decrease. So let's take a look at the increase in deferred tax. You have to debit it in the statement of profit or loss under income tax expense. Then you credit it to the deferred tax position in the current liability column of the statement of financial position. Now, when there's a decrease, the reverse is done. You debit the deferred tax provision, then you credit the income tax expense, which will be an income, under the statement of profit or loss. Let's test our understanding. We are going to take the test of understanding from Tracy to try and explain what we have discussed so far. Here, the carrying amount for the assets for 2015 is 4 million because the asset was bought in 2015 for 5 million. Depreciation was 1 million. 2016 is going to be 5 million less 2-year depreciation, giving us 3 million. 2017 is going to be 2 million, which is the 5 million less 3-year depreciation for 2015, 16, and 17. The tax base is going to be the original cost of the asset less the tax depreciation. So for 2015, 50% of the cost of the asset was allowed. So it's going to be 5 million less 2.5. So the tax base will be 2.5. 2016, 500,000 was allowed. 2.5 less 500,000. Or if you like, you can go the long way. 5 million less 2.5 less the 2016 allowance, which is the 500,000, arriving at 2 million. The 2 million less the tax depreciation, which was 400,000, which will give a figure of 1.6 million. Now the temporary difference is going to be $1.5 million in 2015. This will be a taxable tax difference because the carrying amount is more than the tax base of the asset. 2016 will also give a temporary difference of 1 million, which will also be a taxable temporary difference. 2017 will also give a temporary difference of 400,000. So the tax rate was 20%. So multiplying 20% on 1,005 will give $300,000, which is a deferred tax liability. 2016 will give a deferred tax of $200,000, which is also a liability. 2017 will give a deferred tax liability of $80,000. Now, we have to estimate the movement. The asset came in on 2015, so there wouldn't have been any deferred tax at the beginning of 2015. So it will be 0. So for 2015, there will be an increase of deferred tax of $300,000. When we come to 2016, the deferred tax at the end of 2015 will be the opening for 2016, which will be $300,000. Comparing it to the closing deferred tax, there will be a decrease of $100,000. Now, the opening for 2016 will be the closing for 2017, which is $200,000. Comparing to the deferred tax liability at the end, there will be a decrease of $120,000. So let's come to the statement of profit or loss. So we'll bring the profit before tax, which was 2 million. Then, under income tax expense, we'll bring the current tax. Remember, we saw for that already. 100,000 in 2015, 500,000 in 2016, and 520,000. We now bring the deferred tax. That is 300,000. We debit it. A debit to the income statement is supposed to reduce profits and reduce tax. So when we come to 2016, it was a decrease. So we credit it. A credit is supposed to increase profits, increase the tax. Okay. So we will add it. 2017, there was also a decrease of 120,000. We'll also add it up. So the profit after tax for 2015 will be $1.6 million. The same for 2016 and the same for 2017. Because of the recognition of deferred tax, you calculate the income tax and subsequently the profit using accounting principles, you will still arrive at 1.6 million. If you pick the 2 million and multiply by 20%, it will give you 400,000, which will also give you profit after tax of 1.6. So deferred tax will come in and level up for there not to be any difference in the account. Now let's test another understanding. Christine bought a property for $100,000 on 1st January 2018. Now on 31st December 2020, the property had a carrying value of $70,000 and was revalued to $130,000. Now, revaluation also causes temporary differences. The tax written down value, which is basically the carrying value in tax principles, at 31st December was $6,000, and the tax rate is 20%. We have to explain how the revaluation, including any deferred tax position, should be dealt with in Christine's financial statement for the year ended 31st December 2020. So there are other items too that can cause temporary differences in the accounting base and the tax base of an asset. We can have depreciation, as we have explained earlier. We can have provisions. Let's now take a look at the solution. We will now have to look at the carrying amount of the asset, which is $130,000, which is the revalued amount. Now, the tax base of the asset will not change. So we put the $60,000 here. Now, the temporary difference has increased solely because of the revaluation upwards from $70,000 to $130,000. So there has been a gain of $60,000. If you can remember, that $60,000 will go to the other comprehensive income as revaluation surplus, which will go to the equity column of the statement of financial position. The temporary difference now will be $70,000, which is a taxable temporary difference because the current amount is obviously more than the tax base. Working the 20% on the temporary difference will arrive at a deferred tax of $14,000. There was no deferred tax stipulated in the question, so we take it to be zero. So there's an increase in the deferred tax of $14,000. Now, when we come to the recognition, the increment has partly to do with the revaluation of the asset. When we come to the statement of profit or loss, let's first look at the other comprehensive income. We will debit other comprehensive income of $12,000, which is the revaluation surplus of $60,000, which is shown down here, times the tax rate of 20%. Also debit the profit or loss with the difference of the increment, which is the $14,000 less than $12,000. Then we will credit the deferred tax liability in the statement of financial position with the $14,000 increment. Now let's take a look at losses. If an entity has unused tax losses to carry forward, a deferred tax asset should be recognized to the extent that it is possible that future taxable profits will be available against which the losses will be offset. So when an entity makes a loss, it is termed as a credit for future periods. So that will be a deferred tax asset because you have something to pay lesser taxes in the future. So the benefit has been deferred to following periods. Alright guys, this is where we're going to draw down the curtains on our discussion on IAS 12 income taxes. I hope you have understood everything that we have spoken about. If not, feel free to drop them in the comment section below and we'll do our very best to address it adequately. Whilst at that, kindly click on the red subscribe button below. Click on the notification bell by it. Like and share. Till we come away again, take care of yourself and stay blessed. Poka, poka.